Employee versus a 1099 independent contractor. There are essentially three types of employees. A common law employee, and that's the traditional employee or employer relationship. Second type of employee is a statutory employee, and this is different than a common law because there is an employer-employee relationship, but the employer does not have to withhold federal and state income tax. They do have to withhold Social Security, and they pay FUTA and SUTA, federal unemployment and state unemployment, for the employer. The third type of employee is a non-statutory employee. Two classifications for non-statutory. The first is a direct sales person, and the second is real estate agents. So you have your own classification within the IRS as a non-statutory employee. Your employer doesn't have to withhold federal and state income taxes and does not have to pay Social Security self-employment taxes for you. There are three types of formations of business as a 1099 employee that you can take. A sole proprietor, an S Corp, or an LLC. Sole proprietor is just an unincorporated business that you file your income taxes on Schedule C. There are no benefits for the sole proprietor except that which you buy yourself. The second classification is the S Corp. The S Corp is just it's actually a tax classification, an election that a C Corp generally elects to do. And what it does is it allows income to pass through to the individual. So it's not a legal, the S Corp is not a legal entity in and of itself. It's an election for tax purposes. The LLC, Limited Liability Corporation, is actually a legal entity where you would file with the state articles of incorporation and then choose what formation for tax purposes you want to have. And it's a chameleon for tax purposes. If you're a single member LLC, you're the only one, but you've incorporated, you can have one of three classifications. You can be disregarded as a legal entity for tax purposes, which means that you would just file a Schedule C and the income, net income of the business would flow through your personal tax return. A single member can also elect to be a C or an S Corp. The government wants an even flow of money from you, which is why they set up the quarterly. You could receive one commission check on December 30th for the entire year, and the government's going to average that out over the entire year and say you should have paid quarterly taxes in April, June, September on that income. What do you have to file? You have to file both, because it's a two-tax system on sole proprietors. You have to file federal and state estimated payments as well as self-employment. How much should you pay? Rule of thumb is to take 100% of what you owed last year and divide it by 4. Just some of the tax deductions that I'd like to highlight. a lot of you do a lot of traveling. The mileage from home to the office as a business deduction. Can't. That's commuting cost. The one way to get around that commuting cost is to make a stop on the way in and fill one of your flyer bins at one of your listings. It can be substantial, it depends on how far away that is, where your listings are from your home. But there are some ways around, and then from there, then you're going into the office. Home office deduction. Very few people will take that. It's a very complicated, cumbersome process. The IRS does look at the home office deduction, has in the past. Let me clarify that. They have really cracked down on the home office because everybody was claiming that they had a home office. The two things is that it has to be segregated from the rest of your house, and it has to be used exclusively for the business. The top three taxpayer mistakes. The number one mistake is bad math. Second mistake is forgetting about interest and dividends. And the third thing is not tracking investment basis properly.
I hope that some of what Bruce and I are doing today is acting as a coach. And what a coach does is says, okay, you have the information, now act on it. Take something from what we're giving you and take a baby step and do something. You're 3 times more likely to lose your income through disability and sickness than you are to die.
The other thing you want to manage is your portfolio risk.
You need to consider the asset allocation or the sector that you put it in. And I kind of look at this as the diet that you would feed your body. And of course, this would have to do mainly with how long is the money going to be in the market before we use it, how much risk can we absorb individually, what other assets do we have, and what keeps us up at night. You know, some people the same age can be conservative or aggressive because one's a warrior and one will take a risk. So this is a very personalized process to go through, and you need to get some kind of a contractual agreement on those kind of investments. And you usually get those from insurance companies. An annuity would be that type of a product. Even a life insurance policy can create a way for you to pull income out of it that's tax-free in the future. And it also gets the special treatment that a retirement plan would get, where you're not being taxed on the gain in it. So there are some uses for insurance and annuities. Long-term care is becoming a very important part of estate planning. Rhode Island just became a member of a group of states that has a long-term care partnership initiative. What does that mean? That means that when you do get older and you want to apply for Medicaid, which is Medicaid is the part of our national health care system that pays for long-term care, like nursing home, you have to apply to ask the government to pay that for you. And when you do, they want to make sure that you've spent down all of your cash to a point where it's allowable. Long-term care is a type of coverage that basically acts as a buffer between your money and the Medicaid rules, and allows you to have the insurance company pay for that care instead of having to spend all the money that you've spent so many years saving. And again, the average is 3 years of nursing home care can wipe out 30 years of savings.